Hey, Kevin here, top 100 financial advisor and best-selling author, and we are here to talk about the stock market. Today, we need to talk about inflation. I'm going to give you 3 things you should know about inflation. Now, today it was announced that we had inflation of 7.5%, which means it's 7.5% more expensive now than what it was about a year ago, which shouldn't shock you. We have been talking about inflation for a very long time, which is why I'm not going to panic or shift my investments or do anything drastic, because what the most recent video was from May of 2021. If you've been subscribing and listening, which, if you haven't subscribed, this is one of the reasons why, we've been talking about it for a while. I've been giving you tips about what is around the corner, how to invest about those things, and inflation ain't shaking me at all, because we've already positioned our portfolio for that back in December and definitely in June. This is why you want to read, which is what we talked about yesterday. So again, I'll give you 3 things that you need to know about inflation. So what is inflation? Number 1, that's the rising cost of goods. It is usually caused by having too much money going to too few things. And that's really it. In America today, we had the whole pandemic, right? It wasn't fun. We was all locked down, and most of us saved. I didn't get to go and spend money going to football games and going to Duke UNC games, which I still haven't done. I need to do. I didn't get to do none of that. It was either canceled outright or, it was social distance or whatever. So I got to save, and a lot of people got to save a lot of money. And when things started to open up, everybody flooded to go and buy the stuff that they've always wanted to buy. Well, when you got this much money and only this much stuff, those costs rise. This is basic supply and demand. That's really it. There's no larger conspiracy behind it other than you had way too much money chasing way too few goods, and the prices went up. The other part of it is supply chain. Because of the pandemic, initially because of the pandemic, without enough people producing those goods, you produced less stuff. Therefore, less stuff, more money, higher prices. That's it. When the supply chain relaxes and we start to calm down in terms of our demand for stuff, then prices will level back out. But that's what inflation is. It hurts us all, right? I've said this over and over and over again. Because of supply chain shortage and inflation, I haven't been able to get a PS5. I quit looking. Okay, I just completely quit. I don't care anymore. When it comes to my favorite taco truck up the street, tacos got way more expensive. I'm not fine with that, but I'm gonna be up there on Friday anyway. But across the board, again, things have gotten more expensive, and that's not fun for consumers, especially if you haven't gotten a raise to offset that 7.5% increase in stuff. So what do we do to combat this? Well, the Federal Reserve does what they call raising interest rates. That is the price of money. It is the price of a loan, price of a mortgage. Technically, student loans, you can throw that kind of in there for private student loans. But in either case, they are the ones who control that. When rates are cheap, and they cut interest rates, which they did during the pandemic, and they did in 2008, that is done to spur the economy, to make us spend more money, and to encourage us to spend more money. When they cut interest rates, you get an email from your bank eventually say, hey, look, our rate was 1%, we're going to have to cut it down to 1%. Or I'm sorry, it was 1%, we got to cut it down to a half, cut it down to 0.25. And you say, well, look, y'all not paying me in the bank. I'm going to take my money and go do something else with it. Maybe I'm investing in a bond. Maybe I'm going to invest more in the stock market. I need to get more money than what I was doing saving in the bank. It says, hey, look, money is cheap right now. Maybe you want to go buy a house. Maybe you want to go buy a new car because it's cheaper now. And when interest rates rise, which they are scheduled to do this year, then I get the best rate and costs will never be this cheap again. They may be. We hope they're not, but it may be cheap in the future. But basically, you get the point. I get to lock in something that's really cheap now, and over time, prices are going to get in. I would have bought low when it comes to business loans, when it comes to homes, properties, all that kind of stuff. So that when they're cut, it incentivizes you to go out and spend money, which is what we did, and that's how we got into this inflationary environment. When you raise rates and you make things a little more expensive, you say, okay, well, let me think about buying this house because rates are higher now. Let me think about taking on a business loan because rates are higher now. And it slows the growth down, and it slows that demand down, and says, okay, well, I had a whole bunch of money, but let me put some of this in savings because now my bank is paying me more money to do so. And that's how we cool down the economy just a little bit. You can still grow, but you cool down the economy and you cool down inflation. That is how it has worked historically. Now, what are the three things that you need to know? Usually, and the investor sentiment is, you raise rates, the stock market falls. You cut rates, the stock markets rise. And that is generally true, but I got something for you. Here's how, number one, here's how the stock market has done when the Federal Reserve raises rates 4 times, at least 4 times. So, and here's the thing too, it is expected to, from Bank of America, JP Morgan, depending on who you want to listen to, they're expecting to raise rates starting in March, but at least 4 to 6 times. I think it'll be 4. Personally, I don't care how many times they raise it. I just know it's going to be more expensive, right? I know they're going to raise rates, so my portfolio needs to be ready. All right, so this is from Genevieve Rock Decter. I'll put the name here. She's a CFA, so chartered financial analyst. They are some of the smartest people in finance. That test is real hard to pass. It comes in 3 ways. I am not taking that test at all. Nor do I need to, but you get the point. Very smart people. All right, so she has, since 1978, how has the market done when the Federal Reserve raises rates 4 times or more? 1978, the market was up 0.06%. That ain't great, but I didn't lose money. 1979, up 12.31%. 1980, we're up more than 25%. 1994, I remember that year. Wasn't investing, but I remember that year. It was down close to 2%. So that's the first time it's down. That's number one. 2004, up almost 9%. 2005, up almost 3%. 2006, up 13%, almost 14%. And then 2018, down 6.24%. Really, we're talking 2 years that has been down when they raise rates 2 times or more. I'm sorry, 4 times. 4 times or more. So the stock market can still go up. Now, it didn't look all that great, especially after January, and February has been a little bit rocky. So there's no guarantee that it's going to be negative. That's okay. It may not be the 27% we got last year, but it could be positive, it could be negative. But in either case, don't automatically think, I'm going to sell everything, rates are going up, and I'm going to just hop in next year. The market might be up at the end of the year. It's still early in this game. We've seen wilder things happen, and you can point to 2020 just for that, right? So that's number one. Just because rates are going up does not guarantee that the stock market is going to crash. We're going to be all right, okay? So we could be all right. Chances are we're going to be all right. But even if the market fell a little bit, that wouldn't be the worst thing in the world. You got 27% gains last year. You got double-digit gains the year before that. Like, we've had 3 really good years in a row. A 5% dip is not going to hurt us. Okay, so that's number one. All right, number 2 is inflation is not even across the board. When we say inflation and costs have gone up, yes, they have. And I've felt this in many ways. Many of us have, but it's not every single thing in the universe is up 7.5%. And in fact, I have a graphic to show you as well from Yahoo Finance. And it's really concentrated in a few places. Used vehicles, used cars are up close to 40%. I bought a used car last year. I'm sure I paid a little bit more than what I should have for it, but that was the nature of the supply chain, which we talked about in the very beginning of the video. We had a chip shortage. We could not produce chips that help cars run. When you talk about, your Bluetooth technology and backup camera and all, you need chips for all that fancy stuff. And when you don't have it and the supply is constrained, there are only but a few cars, those prices go up because people were needing cars, people who moved out to the suburbs. I was one of those people, and that was the nature of the environment. It wasn't fun negotiating for that car, but I did it, right? But used car vehicles up 40%. You go to a used car dealership, oh, they're having fun and they know it. I didn't like it, but they was like, look, I was like, well, I can go shop somewhere else. I was like, go. Somebody's gonna buy this car. And in fact, the car that I ended up buying, which is on Instagram, it's a 2008 Lincoln. It's decent. But when I looked at a car, I wanted to get an Audi. It was a used Audi. I thought it was really nice. Never drove one, but I thought I was a little fancy. I had saved up some money. I was going to buy it in cash. Okay, so I look at it. I read up on it. Mileage is good. Everything's good. It took me 12 minutes to get to the dealership. It was free and clear. No one had bought it. But in 12 minutes from the time I left my house to go and look at the car was sold in 12 minutes. And I called in advance to say, look, is this car sold? They said, no, you come look at it, come buy it if you want. Got there, car was gone. The Lincoln was the next one to it. Ended up being an even better deal for me. That's how crazy costs have been and how great things have been if you are a used car dealer. All right, so yeah, used vehicles at the top at 40.5%. Gasoline is up 40%. Rental cars, again, all because of the chip shortage, up 29%. Transportation, hotels, furniture, that's where the majority of that stuff is. Then you go all the way down, college tuition shouldn't be growing at all if you ask me, but at the bottom it's up just 1.9%. That's not that bad. And overall inflation, again, up that 7.5%. But again, you can see here it's more everything related to cars, used cars, gas, stuff like that. That is where the majority of the concentration of inflation is. So really, if you could solve the chip shortage and the supply chain issues, that would really help us a lot. The answer to it is simple, right? But that's what you need to know. It's really concentrated in one area. Not clearly everything is up, right? But that's really where the majority of the issues are. I would really keep my eye on, and I'm telling you, I'm not saying this to invest in it, but I really keep my eye on, the Fords, the GMs, the Teslas, because that's really going to help them when this supply chain shortage is over. They've hinted at it, that it could be this year. Others say early next year. We'll see, but they will be able to produce more. I would expect those companies to do a whole lot better once this whole thing is over with the supply chain issue. Also, gasoline being as high as it is, which is trash to everybody, right? But if that starts to dissipate, or if it stays where it is, electric cars become a lot more attractive. Just throwing it out there, right? That does help Tesla. It also helps a Ford. It may help a GM as well, but just throwing it out there. So that's number two. Inflation is not consistent across the board. Everything isn't up 40%. Cars are, gasoline is, but things are a little more mild, thankfully. You solve that, you can solve a lot of the other issues when it comes to inflation. All right, and then the last thing, and we've talked about this a lot, is in a time where inflation is high and the Federal Reserve is expected, and I'm giving like a 99% chance they are going to raise rates multiple times this year, where do you invest? When rates rise, typically these high-flying stock names, these high-flying tech names tend not to do well. That is because some of them are not profitable and they have to borrow money to make stuff run, right? Well, if I'm borrowing money, I'm paying an interest rate for that. The interest rate is going up. That's cutting down what could have been my profitable year, and it really hurts me if I am a tech company, with the exception of like an Apple and a Microsoft and maybe a Google, because they have so much damn money to begin with. They don't really have to borrow nothing. They got the cash, right? So those are fine. But a Unity Software, a stock I used to like before this happened, right? Maybe in a firm. I'm not sure where PayPal falls into this. I'm not sure where Square falls into this. But if you don't already have an established war chest of cash, and we're talking billions and billions and billions of dollars sitting on ice, this is not a time to be jumping into, this metaverse company that I've never heard of. That might not be your best bet. Maybe an Nvidia, maybe Microsoft and Apple, those might work. But these new tech names that haven't had the history and the cachet and don't have the cash, that's not the best place for you, so says history. The places that do work, we talked about this before, real estate, REITs. Did a whole video on those, right? Y'all know which ones I invest in. We talk about REITs, talk about healthcare, and I had another one here. Obviously, how can I forget this one? Here, REITs, healthcare, and banks. These are, you can say all financial companies, not all, most financial companies. Things like Allstate tend to do well. A lot of those insurance companies, AIG, they tend to do well during this time as well. But we talked about United Healthcare. I talked about dividend stocks. Those tend to do pretty well as rates rise. And again, real estate investment trusts, REITs. We've been covering this for a while, which is why you saw me back in December buy into Prologis, which was a logistics REIT. That's why I jumped in there, right? I kept a Target because they tend to be more defensive. I kept a Capital One because they're definitely going to be impacted by rising interest rates, and I would expect them to continue to do well. We talked about JP Morgan, the Goldman Sachs, the list goes on. We even did a whole breakdown about Ally and Goldman Sachs, and we did kind of a versus video there. All that stuff is there, but that positioning should have happened already. I had a friend of mine, Todd, on Public say, hey, if you haven't adjusted your portfolio, you're doing it wrong. Well, we have been adjusting our portfolio since May when we talked about it, right? We even made more tweaks and adjustments in December to get ready for times like this, because this is where people panic, right? You may not have read, you may not have known that this was coming. we've been knowing it was going to come for a while. I didn't know what day. I know something's going to happen in March in terms of them actually raising rates. But in either case, the market's going to react the way the market's going to react. And these particular areas are going to do well, or tend in the past to have done well. So whenever it happens, I can sit back and relax. Come holler at me in June, and then we'll come back and we'll reassess, see if we're right, and tweak and make further adjustments at that point in time. This is how you create a good investing strategy and have a place to, just really let your wealth grow without having to worry about it, because you've already foreseen to a degree what's going to happen, right? And again, we can't tell the future. There's no guarantee that these things will play out the way we want them to, but it is almost a guarantee they're going to raise rates. It is almost a guarantee that when rates rise, these are the places that investors move to. If you're already there, you're good. You just sit back and wait for things to play. What you don't want to do is just react to stuff. It's, oh, inflation's high, let me sell out of everything and cry. That's, if you knew, I know how it feels. I've been there, but that's not what you want to do right now. You want to look for companies with cash. Okay, they got cash on their balance sheet, which you can find out looking through their quick information or even their balance sheet. If they got cash, that might be a place you want to go. That means they don't have to borrow. They're set, right? They are financially solid. Look at healthcare. Look at REITs. Look at some of these dividend stocks that have done quite well. Those are the places you want to be, and you want to sit there and hold it and sit tight, because it can be a little rocky. The market is going to overreact to a lot of stuff this year if you haven't noticed it already. Should the market have been down this bad? No. We all knew that inflation was high. We all knew that. What in the world happened in the last month, the last 2 months that would have reduced inflation? Nothing. There's no reason as to why the market should have reacted the way it did, but it did. We talked about Netflix dropping 20% in a day. We talked about Meta, Facebook, y'all get the point. That dropped 25% because they lost users one time in their entire history. Is it a red flag? Yeah, sure it is, but 25% in a day? The market overreacts. That's fine. We're going to stay on the path. We're going to stay on, right? We're going to stay disciplined, stick with the process, stick with the research, and you're going to be fine. So I'm not reacting. In fact, you already know what I'm going to do. Tomorrow is DCA Friday. So I'm going to go buy what I like buying and keep it pushing. All right? That's it for me. I'll talk to you guys later. Bye.